Good morning from the For the CME. This is Chris Robinson with your Traders Exclusive comment for today. Monday, we had the USDA report. That's the biggest thing that has moved soybeans. The biggest surprise was the fact that the USDA increased the national average yield to over 50 bushels an acre. Tremendously large crop coming down the pike, a lot larger than people had thought. This is only September. We'll see where we're at really at the end of October, November when the final numbers are in. Generally, there's an expression, big crops get bigger. So what happened? Well, the funds who have been long 90,000 contracts of soybeans sold about 15,000 contracts on Monday, continue to be sellers. Selling accelerated when we got below the 200-day moving average at 969. For the rest of the week, that's the number I'd watch, that 969, 968 area. That could be a magnet for a future trade, but I think right now the market is pricing in a retest of the old lows. And if you look on the charts, you're looking at 937, 910, and then it opens it up down to 868, which was the low for the year. So it's been a very volatile year in the soybeans. We've had over a $3 move, and now we've come back down. But that's really the number one thing that came out of the USDA. Wasn't very friendly for corn or wheat, really, kind of neutral for wheat, but not very friendly for corn. You did see initial bounce, but that has come under some more sell pressure as well. Why? Well, the funds are short 170,000 contracts of corn. They're short a record position in wheat, 125,000. So are we going to continue to roll over? What's going to happen to soybeans if these funds decide to go not only get flat, which means they've got about another 70,000 contracts to sell? What if they decide to get short? So you really have to focus on the commitment to trader news that we get every Friday. And you can see, got to watch the money flow. It's been the money flow, and then it's been the technicals, which has characterized 2016. I'm going to shift over now and talk about the livestock. We had a decent bounce in the fat cattle and feeder cattle. That has given way to more sell pressure. We've seen this really for the past 9 to 10 months where we get these rallies, it looks like the lows are in, and then we roll over again. So the old expression, the trend is your friend, the trend continues to be lower in the fat cattle and feeders. Of course, if you're a producer, you don't like to see that. The trend is going away from you. So it's really important that you make sure that you're doing the best job of protecting the prices that are available currently. We've seen a lot of volatility in the lean hogs as well. That's the last thing I'm going to talk about with the livestock. It looked like we had carved out a bottom, like we might have bounced higher, and then we've had a continuation again to the lower trade. As I walked over here, we had lean hogs at about a 10-12 month low, going back to where we were Christmas of 2015. That's pretty negative if you're a hog producer. Again, what do they start searching for then? You start looking back and seeing, well, where was their support on the charts? So lots of opportunity. The trend continues to look like it's lower in the grains and the livestock. We always look for change in trends as an opportunity, but for now it looks like the trend is maintaining. And then real briefly, I just want to talk about what's been going on in the stock market. I was a guest on Fox the other day, on Friday, the day we had a 300-point move. And time again, people forget that it's the percentage moves. When the stock market's at 18,500 or 18,000, 1% is basically 200 points. Most professionals think that 5% or less is just noise. So you do the math, 5%, it's 1,000 points. So if we stay at these levels, where the index is double what it was back in 2009, you're going to have 200, 300, 400-point moves. I can remember when I was in the Dow pit trading every day, the Dow was around 10,000, 11,000. We had 300-point trading ranges every day, and we would trade up and down and up and down. And so that was a much more volatile market. Don't fall into the trap that you don't think that we could have that type of volatility returning in the stock market. So if you're upset about 200 and 300-point moves, just wait until we start getting real volatility. Just wanted to mention that. I get so frustrated when people get focused on the flat number. It's not the flat number, it's the percentage that matters. This is Chris Robinson. If you're looking for help, you want to talk about your trading, about your hedging, I'm on the web.